Hello and welcome to this special series, Financial Experts Unplugged. Joining me today is the founding team of Flexi Capital, one of India's fastest growing financial advisory firms. And with me is Nasser, Ankit and Sanket. Thank you very much, all three of you, for coming by and talking to me.
Thank you.
First question, lots of concerns around investors, a lot of volatility. We are seeing it both in equity, we are seeing it in debt as well now, a lot of concerns around that. What's the kind of feedback you're getting from your investors and what are you telling them?
Thanks, Vivek. So firstly, I think clearly as far as the current sentiments are concerned, frankly, clients, there is a very important message that we want to give as one team, which is stick to your asset allocation. That's the first advice. Because in current times, we see a lot of volatility across debt, equity, which are broadly two asset classes where investors put in their monies. And volatility is something which we need to accept and live with. And that should not change your investment horizon basis your asset allocation. And I think the message is clear. Please stick to your decision on the asset allocation and the model. And please engage with your advisor. Because if you stick to your decision, the end result will be achieved. And in the current scheme of things, debt has obviously been far more volatile as compared to what it was in the last few decades, and especially in the last few years. And that's because circumstances, again, right? We've had certain amount of discredit, if I can say so, in the NBFC space, as we know, which have also lapped up a lot of mutual funds as we speak. But does that mean that are you losing your money? No, it's just a phase. Right. So again, on coming to equity as an asset class, muted returns, but from a valuation perspective, we talk about basic multiples on valuation, which determines the choice of equity funds one kind of recommends. And if you're in the right recommendation bucket and basket, you should continue to hold because the returns are muted for now. But are we saying they will not deliver over the next few quarters? The answer is obviously correct. They will deliver, because you've decided on a particular model. And in this case, I keep talking about the asset allocation model because that is key in determining your end result.
So how do I determine what is me as an investor's right asset allocation? How do you go about figuring that out?
See, I think there is a thumb rule which normally in asset allocation we follow as advisor. So that's called age-based model, wherein whatever is your age minus 100, that should be your asset allocation, maybe equity debt. For example, if you're 40, right, then you minus that 40 from 100. So that means this 40 and 60 is your debt equity ratio which you have to come out with. But we have to remember that asset allocation also varies from the goal. Because, for example, I want to buy a car which is in the next 6 months. I can't put that money because age-based model will say you can put maximum in your equity. But that pot of money I can't put in the equity because I'll be volatile. I need to be very careful while selecting that asset allocation. And I think that's where advisors will come into play, because advisor's role is to educate the client. And this is how we can educate. Right?
So when you have multiple goals, like Ankit talked about, for somebody it could be buying a car, for somebody else it could be buying a home, for somebody else it's planning for your child, and for somebody it's retirement, and for most people it could be all of this. So when you are consistently and continuously playing with multiple goals, so what will then my asset allocation look like? Will it be separate goal centric because my portfolio is one at the end of the day, isn't it?
So there could be two ways going about it. As Ankit mentioned, that if it's a specific goal and it's a very short-term goal, then yes, you will put everything into debt. Or the second way to, as you mentioned in your question, that if there are multiple goals, then, and say one goal is 6 months away, other is 12 months away, say your retirement is 10 years away, you can club those and you have an X saving rate of a particular family. You then extrapolate, including the inflation, that what will be the money required after 6 months, 12 months, or 10 years, and draw the weighted average out of it and you come to an IRR that, okay, this is the IRR you require. Say, for example, you require, say, a kind of a 10% IRR. So in current scheme of things, hypothetically,
Yes, sure.
that to achieve a 10% kind of IRR, you say need 70% into debt and probably 30% into equity. And that map that 30% equity to retirement, because you don't need this money. You need this money only after 10 years. And 70% of that, okay, you need this money after 6 months, 12 months or 3 years, that goes into debt. And stick to that. And map the values. Whenever the goals have arrived, you bring that money out of that particular asset and use it.
And one keeps hearing the word or the term rebalancing.
Sure.
That you can't set off on your journey and say, if my debt to equity mix is 60-40, I'm just going to remain at 60-40 for the rest of my life. How often should that be done?
You see, Vivek, there is no thumb rule to it, but it's a function of the returns that you get in your particular asset classes. In continuation to what both Ankit and Sanket just mentioned, different goals have different time horizons and therefore different asset allocations. Clearly, if you started out with, say, for example, hypothetically again, 50% debt and 50% equity, and if the market has run up all of a sudden, the 50% equity portfolio will start to kind of be overweight at a portfolio level. And that's when you need to actually go back to your basics and understand that if you're overweight in a particular asset class, in this case being equity, we need to reduce the equity component and bring it back to the original 50-50. Having said that, I think the other thing also that I want to add between all of this, Vivek, is that at a granular level and more at a large portfolio level, we always would like to see all our clients come and discuss this with everybody, is that have a core portfolio, which is your core objective and goal, and then comes in satellite portfolios. Satellite portfolios could be what Ankit and Sanket said. For example, I have a contingency reserve fund. It should not ideally be a part of your core portfolio, because core portfolios generally, and in generic speaking terms, is longer duration ideally. Because somebody who's in his mid-30s may want to have a core portfolio which is hyper growth, for example, to achieve, and over a 15 to 20 year period. For somebody who's at 55, may have a core portfolio which is willing to ensure that he gets into the distribution phase, which is the drawdown phase, at the age of 60, because he needs to draw down his investments, out of his investments every month or every quarter or every year, depending on what you recommend. And therefore, the core portfolio needs to be time-based, longer horizon, and with an objective. Satellite portfolios, therefore, then can meet smaller objectives and smaller goals. And that fits in beautifully again at a macro level portfolio management scheme of things. So that's my point on that.
To add on the rebalancing thing,
Yeah.
so there is not a single thumb rule.
Yeah.
But for a normal investor, ideally he should look at the overall asset allocation once a year.
Once a year.
Once a year at least, once a year. And suppose if we go in with an example of say 50-50, 15 to debt and 15 to equity, if after the end of the year, if something has gone up by 8 to 10%, any one asset class, trim that and rebalance it. So what is happening is, today, every investor is taking decision because of emotions. Today market has gone up, let's book profit. No one knows that market will go up from there or not, or will come down from there. It's just the emotion. What this asset allocation and especially rebalancing do is, it removes emotion totally out of it. So suppose if I have put a benchmark of 10%, so if any asset class has gone up by, say it has to be 50-50 and equity has gone up to 60 and I am at 40, debt becomes 40, then I trim the profit whatever happens. That okay, I have made, my asset allocation has gone haywire because of equity going up, so I trim the profit and bring back to 50-50. So what is happening, I am removing emotions. It's only pure mathematics.
And does it work?
Beautifully. If you backtest it,
Because most people would, would say, what is he saying? I mean, if I've made money, it's gone up, it's great. Let it go up even more. Why should I trim it?
I think, so as mentioned by Sanket, you have to remove the fear and greed from your investment decision.
Easier said than done. But hard data, which you all deal with,
Yes.
does that show that, between two people, one who just followed asset allocation and the other person who just chased returns of one asset class versus the other. The one who stuck to asset allocation got better returns?
Yeah, definitely. I can give an example. So we have a client. We have done asset allocation, and there was a time when this client says, "Oh, market is doing so well here. Let's forget about our debt equity composition. Let's move more towards equity." Now with that decision, we informed him, sir, as an advisor, we told him that we should stick to our asset allocation, right? So he said, okay, let me just, there is a portfolio outside, let me just tinker with that. Your portfolio will go by you.
Okay.
Right? Whatever you are saying. Now that greed, because of which he went 90-10 equity, 90 and 10 debt. Today when we discuss with him, he says that you guys were right. Today at that time when market was looking all good, we are all in, markets, your valuation is just going high, people are in that toxic zone that, we'll make money next day in markets. Today is a time when they realize that, we should not lose our senses when markets are doing well. Right? And it's a vice versa also. Right? If markets are not doing well and there is a fear in the market, then as an advisor, we need to advise our clients. So that fear when prevails in the market, then of course at that time also you should stick to your asset allocation. Whatever is the amount.
That is what, as Sanket said, the difficult part, right? That's when you start getting the phone call.
Yes,
definitely.
Yes.
Market's going up, what are you doing? Go from 50-50 to 60-40.
Yeah. So eventually, and also, to add on, once you are about to approach to your goal, like we discussed when to rebalance, then when you are near to that goal, then of course you need to start trimming your equity positions if you're goal-based, like a satellite portfolio, because you don't need a volatility at that point of time. When you're about to, say, buy a house, 1 year down the line I want to buy a house for which I've already collected 5 crores. It's lying in my equity portfolio, right? I can't leave it over there because now my goal is nearby. So I want to gradually move it to conservative.
That changes dynamically.
So Nasser, we talk a lot about equity, and it's very recent that people and the media and people have started talking about debt as well.
Sure.
Now, unfortunately, just as we started talking about it and investors became a little more aware about it, we've had a few accidents out there. And again, you pick up the newspaper in the morning and you see, oh, X has defaulted, Y has defaulted, and immense volatility in a particular scheme.
Sure.
How has that played out with your investors? What is it as advisors that you're telling your investors? Because many people feel that, oh my God, we thought debt was safer, and less risky, or some even thought it was safe.
Sure.
And here you're seeing this massive volatility. I mean, from whatever you've seen so far playing out, is there any cause of worry, concern? If I'm an investor in a debt mutual fund, what should I be doing right now?
So clearly, Vivek, that's actually the best part of your question so far, and the most difficult one as well, I must tell you. But as advisors, here is what we're recommending, and what we feel. So, frankly, for the last quarter or so, we've had a lot of negative sentiments coming up on the debt space. But again, we have to understand where it's coming up in the debt space. It's clearly only in the credit space as we speak. And unfortunately, and we must admit to this, a lot of promoters have gotten money on account of namesake. Now, clearly, to answer your question, if we go back to basics again in principle, you need to check, revalidate your debt funds, for example, and especially in the credit space, because that's where the negative news is. So if you look at CPs and treasury bills and so on and so forth, those have not been impacted so much. So simply because those have been not in any volatile scenario over the last few quarters. But if you understand the credit space, that's where you've invested the money. And some of those credit spaces have actually not done really well because they've delayed their interest payments. For example, in September of last year, we saw ILFS issue coming up, followed by some of the larger names like DHFL, where the intention was very clear. DHFL today, I must also admit to you, is paying up. They've raised money. They've got Aeon Capital now, which is coming in and restructuring their entire portions which need to be paid back.
So you're saying these were more interim, temporary
problems. And I must tell you, to your advice, when you go back to clients, what we're doing is we're telling them we're doing a very simple score. And we're saying, what is the percentage of your holdings at a portfolio level into the credit space? And wherever there is an opportunity where we feel that it will not impact returns going forward, And if you've completed a certain number of years in that fund, we're recommending you to switch out, not ride the volatility anymore, get into an arbitrage kind of a fund. That's our in-house view, because we feel that if you've achieved the objective, and if you've taken a little bit of a haircut, and if you're getting worried about subsequent returns, then move out of it, check out your credit quality, move out of it and get into, if it's inferior, then come out of it and get into an arbitrage fund. That's our first recommendation. I think the second very important point is which asset manager today you're sitting with. And we have no bones about this. We want to break no bones. I think amongst all of these, see, SEBI has also pushed for something called side pocketing. So, I mean, I don't want to get into the specifics of it now.
Sure.
But broadly, if you see, and if you look at all the asset managers today, I think the ones that have pulled out this beautifully without impacting client returns. So, for example, if you look at some of these asset managers, you need to go back to the basic principle to understand who are the ones who've had least impact on your portfolio returns. And that is very critical because there are many enough players in the market, for example, asset managers, who've shown very less volatility on the credit space because they've picked up the quality of the scrips and of the debt funds that they've invested into. The underlying assets are actually very good quality even in the credit space. So that's again something which is very important.
So one thing that this crisis or accident has really shown up is that it's not very easy to go out there and try and select a debt fund on your own. It also takes a lot of effort to zero in on a good debt fund, just like it takes
on an equity fund.
Yes. So research work really goes in. For example, in a diversification, when we talk about asset allocation, then your asset allocation means that you have to be diversified in the asset class, means equity, debt and cash. Also, you have to be diversified within the asset class. These are two different things. Once you are in debt, choosing the right fund, and also, for example, you are putting in 40 rupees in debt, you should be adequately diversified in that also. That diversifies your risk, maybe across the AMCs, because everybody has a core competency. Somebody is very good in debt as a AMC, maybe you can choose that. Also, you need to, we in Flexi, we also see a track record of the fund manager. How is he doing? What is his pedigree in terms of how he has performed in the last 12 years? And then only we choose the funds and bring it on the table for our clients. So diversification is very important in that sense.
My last question, Sanket, for you, that we've seen this trend emerging of do-it-yourself, people trying to, and there are platforms available which allow people to transact on their own, and the regulators also created a direct kind of a mechanism. Perhaps misunderstood. The idea was not to say don't take advice. The idea was to give another platform and you negotiate your fee. But when you talk of asset allocation, from what I've heard the three of you talking about, you probably will need an advisor, right, to take you through these intricacies of it. It's not just simple, as simple as picking up 3 schemes which somebody says are top rated.
Correct.
Right? It's a lot more than that.
Correct. I tell you one thing. All the mutual funds have 10-20 pages of Kim and Sid. How can you commoditize a mutual fund that only buy it on performance? If that is the case, then Kim Sid should go down to 1 page. So those are so technical. Today, as we in your show, we discussed about the debt funds. It was pretty safe 1 year back.
Yes.
But now came out the nuances that you should see the portfolio, and a normal investor can't
figure out.
Yeah, he's expert in his own domain.
What's the credit rating? What is this? Absolutely technical.
And even besides the returns, if even we put, say, like standard deviations or mean, it becomes too technical. But it is valid from an advisor point of view to look at those parameters. So you cannot remove human intervention, and you could be in a different financial situation, he could be in a different financial situation. Today, we manage 150 clients, all have 150 different financial plans. So how can, say, only one solution is there for every client? No, it is impossible.
Great talking to all of you, and thank you very much for coming by here on the Money Mile. Wish you all the very best. May you continue to guide investors as you've been doing. Thank you.
Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.